In this video, we're going to talk about Warren Buffett's secrets to making millions during a market crash. So before starting, please do like the video and subscribe to this channel for future updates. If you could only listen to one person's counsel during a stock market crisis, make it Warren Buffett, the world's most famous investor. Not only can the chairman and CEO of Berkshire Hathaway's advice benefit you, but his ability to keep a level head and even get a little greedy, more on that later, while everyone else is selling, may make his the only guidance you need to navigate tricky times. Indeed, Buffett's ability to shut out the noise and remain hopeful in the face of adversity has been critical to his unmatched success over the years. Berkshire's market value climbed at an annualized pace of 20.9% between 1965 and the end of 2017, more than twice the S&P 500's average annual growth rate of 9.9% over the same time. Berkshire's market value has grown at 20.9% annualized pace, resulting in a total return of 2,404,748%, far more than S&P 500's 15,508% gain over the same period. This performance was notable in light of a number of difficult financial times, including the 1973-74 stock market crisis, Black Monday, the dot-com bubble burst, a steep pullback following the September 11th attacks, and the more recent Great Recession between December 2007 and June 2009. Buffett knows a thing or two about stock market crashes, to put it mildly, so without further ado, here's some advice from the Oracle of Omaha on market downturns that are unavoidable. Number 1, stocks can fall far, and they can fall fast. When it comes to stock investing, there's always the possibility of a severe downturn. Stocks, in fact, not only fall frequently, but they also completely are unpredictable. There is just no predicting how far stocks can fall in a short period. Buffett wrote in his most recent shareholder letter, "Consider the following data from Capital Research and Management Company on the frequency of big Dow Jones Industrial Average drops between 1948 and December 2017. According to CFRA Research, the S&P 500 plummeted 5% to 9.9% 56 times between 1945 and July 2016, 10% to 19.9% 21 times, 20% to 39.9% 9 times, and 40% or more 3 times between 1945 and July 2016 via the American Association of Individual Investors." Number 2, avoiding leverage will give you greater clarity. Investors must be able to remain calm in order to make good decisions during a stock market crash. Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Buffett has said, what you need after you have average intelligence is the temperament to control the urges that get other people into financial trouble. While there's no guarantee that investors will be able to resist irrational and emotional impulses that could lead to poor decisions during a downturn, there is one way to almost guarantee poor judgment if things go wrong: trade on margin. Debt distorts all investment decisions, particularly during a stock market crash. Even if your borrowings are small and your positions aren't immediately threatened by the plunging market, your mind may well become rattled by scary headlines and breathless commentary. Buffett wrote in his most recent shareholder letter, "And a mind that is unsettled will not make good decisions." Number 3, don't try to time the market. Don't try to predict when the stock market will crash. Just be aware that they will arrive. Buffett detailed 4 instances in Berkshire's 2017 shareholder letter when the stock fell 37% or more, describing them as truly major dips. The biggest decline occurred from March 1973 to January 1975, when Berkshire stock declined a whopping 59%. In the next 53 years, our shares and others will experience declines resembling those in the table. Buffett said about these 4 major declines, "No one can say when these things will happen. The light can change from green to red at any time without resting at yellow." These reversals, which were all accompanied by broader stock market declines, are unquestionably painful for investors. Trying to time them, no matter how badly you want to avoid them, is a fool's errand. Number 4, don't view stocks as ticker symbols. Investors should remember that they are business owners, not ticker symbol owners, so keep a clear mind during stock market disasters. While stock prices may fall, the bulk of companies with robust business models and competitive advantages will likely see significantly less of a negative impact on the underlying businesses during these times. As a result, make sure to separate stock success from business performance. Charlie and I view the marketable common stocks that Berkshire owns as interests in businesses, not as ticker symbols to be bought or sold based on their chart patterns, the target prices of analysts, or the ideas of media pundits. Buffett wrote in Berkshire's most recent shareholder letter, "Instead, we simply assume that if the investees' businesses are successful, which we expect they will be in the vast majority of cases, our investments will be successful as well." Number 5, stay invested. Although major stock market declines and crashes have been shown to occur frequently throughout history, an even more consistent pattern has been the powerful wealth-building returns of stocks over time. For example, when dividends are reinvested, the Dow Jones Industrial Average has increased at an annualized rate of 10.3% over the past century and a half. Don't be that person who gets caught in a downturn and starts selling off their investments. In point of fact, you should be the type of investor who keeps the majority, if not all, of the portfolio invested. In the shareholder letter that Berkshire sent out in 2012, Buffett discussed the significance of maintaining an investment strategy. Because the fundamental game is so advantageous, Charlie and I are of the opinion that it is a terrible mistake to try to dance in and out of it based on the turn of tarot cards, the predictions of so-called experts, or the ebb and flow of business activity. This is because the fundamental game is so advantageous. In comparison to the dangers of taking part in it, the potential downsides of sitting on the sidelines are much more severe. Number 6, go shopping. Going on the offensive rather than selling stocks during a recession is an even better strategy than selling stocks at all. When markets are rising, investors have a better chance of finding great companies selling at reasonable prices. However, it is uncommon for them to come across wonderful companies that are trading at a significant discount to their fair value. When the stock market crashes, however, there is a small window of opportunity during which high-quality companies can be purchased at a discount. Go shopping. Be fearful when others are greedy, and greedy when others are fearful, as the famous quote attributed to Warren Buffett advises, or take into consideration a more recent quote from Buffett: "When major declines occur, they offer extraordinary opportunities to those who are not handicapped by debt." Number 7, stay focused on the long haul. You shouldn't let yourself get distracted by short-term economic forecasts or the headlines that are trending at the moment. Regardless of whether these stories are filled with unbridled optimism or despair and doom, investors are not the same thing as traders. They are proprietors of businesses who think on the long term. Therefore, remember to keep your attention on the long haul even during difficult times. In the shareholder letter that Berkshire sent out in 2017, Buffett outlined this approach. The rise and fall of stock prices appears to be unrelated to any progress made from year to year in the fundamental worth of the company's shares. Ben Graham's oft-cited aphorism, which states that in the short run, the market is a voting machine. In the long run, however, it becomes a weighing machine, has been shown to be accurate throughout the course of time. In a nutshell, remain calm and be patient. Last but not least, take some of Warren Buffett's upbeat outlook to heart, as demonstrated in a quotation from Berkshire Hathaway's shareholder letter from 2012. The prosperity of American enterprise will be preserved over time. Because the fate of stocks is dependent on the performance of businesses, it is inevitable that stock prices will rise. There is a possibility that investors and managers will suffer setbacks at regular intervals, but the odds are overwhelmingly in their favor overall. During the 20th century, the Dow Jones Industrial Average rose from a value of 66 to 11,497, representing a remarkable growth of 17,320%. This occurred despite the occurrence of 4 expensive wars, the Great Depression, and numerous recessions. Also, keep in mind that shareholders have been paid considerable dividends over the whole century. The stock market has always been able to weather severe market downturns such as depressions, recessions, and corrections, and it will continue to do so in the years to come. Therefore, if you find yourself in the midst of a fall in the stock market, it is imperative that you refrain from incurring debt, maintain a focus on the long term, and make the most of any opportunities to make purchases. Every downward trend will eventually be followed by an ascending trend. So, what do you think about our video? Let us know in the comment box below, and please do like this video and subscribe to the channel for future updates.